Did you know you can buy expensive machinery without paying custom duty, or you can buy locally and get full GST refund? Yes, it is possible with EPCG scheme. EPCG means Export Promotion Capital Goods. Hello and welcome. I am Koti, one of the directors of Group. And in this video, I will explain about EPCG scheme, what it is, how it works, who can apply, and how it will be closed successfully. The EPCG scheme was launched with one clear goal: to boost India's manufacturing capabilities and improve the quality and quantity of goods exported from our country. It allows exporters to import high investment capital goods without paying any custom duty, thereby reducing the financial burden on the manufacturer significantly. But the only condition is that exporters must fulfill a certain export obligation within a specific period. Whether you are setting up a new unit or modernizing your existing setup, capital goods are the heart of the manufacturing. They include plants, machinery, tools and accessories to produce the goods. EPCG scheme helps you save a lot on taxes, freeing up your capital for business growth. You can import capital goods without paying any custom duty at the time of import. Custom duty includes basic custom duty, IGST and cess. For those who prefer to buy the machinery from Indian manufacturers instead of importing, they can claim GST refund within 3 to 4 months time. The EPCG scheme mainly benefits manufactured exporters who make and export their product. But even merchant exporter can also apply, providing they have a supporting manufacturer. Service providers like hotels, hospitals and software companies can also apply for this scheme. Applications can be made on the DGFT portal, which stands for the Director General of Foreign Trade. Before filing the application, you need to update your IEC, RCMC, GST and MSME details in the DGFT portal. At the time of application, you need to fill up the details like factory address, export product details, machinery's name, HSN code along with the model number of the machinery. Once your EPCG license is approved, you can start importing the capital goods. Imports must be completed within 24 months from the license date. Before importing, you need to register EPCG license with concerned customs authority. At the time of registration, you have to submit the documents like IEC, RCMC, GST, MSME, CA and Chartered Engineer certificate, bond, 100 rupees stamp paper, bank guarantee depending on your eligibility. While filing the bill of entry, make sure that all the details like HSN code, item description, model number, quantity and values exactly match with your EPCG license. After clearance, goods can be imported without paying any custom duty. Once the machinery arrives in the factory premises, you have to submit an installation certificate to DGFT department within 6 months from the date of installation of the capital goods. If you prefer to buy machinery made in India, after getting EPCG license, you need to get an invalidation letter from DGFT in supplier's name. Once invalidation letter is approved, you can procure capital goods domestically. Ensure the supplier mention the EPCG and invalidation letters on their tax invoices. After supplying, the supplier must file the GST returns in deemed export category only. You, the recipient, should not reverse the GST input credit. Instead, you maintain the GST credit ledger to claim GST refund. The GST refund process usually takes 3 to 4 months time to claim a refund from the GST Council. This is the most important part of the EPCG scheme. This is the promise you make to the government that you will export the goods made using the imported machinery. There are two types of export obligations. One is specific export obligation and second one is average export obligation. Specific export obligation means you need to export the goods worth 6 times of duty saved amount within 6 years times from the date of license. This export obligation must be fulfilled in 6 years. Minimum 50% you should have to fulfill in first 4 years, remaining 50% in another 2 years. If you cannot fulfill export obligation in time, you can take an extension for further 2 years. The average export obligation is based on your past export performance. It's calculated as the average exports made in the preceding 3 financial years for your similar products. It should be maintained every year until fulfillment of export obligation. For new units, it started as a 0. Once your export obligation is completed, you need to close the license. Its process is called redemption. You need to apply for EODC in DGFT portal. EODC means Export Obligation Discharge Certificate. You need to submit export proof and other documents along with application. After verification, DGFT issues EODC and sends a copy to customs. This confirms that your export obligation is completed and your EPCG license is officially closed. After EODC issue, you have to approach to customs for release of bond and cancellation of bank guarantee. Once this is done, your EPCG cycle is completed. If you fail to fulfill the export obligation within 6 years, you need to pay custom duty along with applicable interest. If you find the process confusing or complicated, you don't have to do alone. We at Unigroup can help you apply, manage and close your EPCG license smoothly. If you find this explanation is helpful, please subscribe our channel for more videos on government subsidies and export incentives. Thank you for watching.